You have been hearing about El Mencho. You have been hearing about the tariff war with China. You have been hearing about silver at $88. But here is what nobody is connecting for you. Those three stories are not separate stories. They are one story. And the story is about something much bigger than a commodity price. Two nuclear-armed superpowers are fighting a war right now. Not with missiles, with money, with resources, with supply chains. And silver is the weapon both of them reached for at the same time. By the time I finish showing you how this connects, you are going to understand why the paper price at $88 is the last number in the world that reflects what is actually happening. And you're going to understand why the people who figure this out first are going to be very glad they did. Let me start with a number that stopped me cold when I found it. After the COMEX smashed silver down 30% on January 30th of this year, something extraordinary happened on the other side of the planet. Shanghai did not follow. The Shanghai silver price held firm, and the premium that opened between Shanghai and the Western paper price exploded at 29%. 29%. A $22.98 per ounce gap between what China was paying and what COMEX said silver was worth. Add the 13% VAT that Chinese buyers pay when they withdraw physical metal from exchange vaults, and the real delivered cost of silver inside China hit 45.8% above Western prices. Over $36 per ounce above COMEX in one day. That gap created an arbitrage opportunity worth over $34 per ounce after shipping. For context, air freight for bulk silver costs roughly $2 per ounce. The profit available from pulling silver out of London and New York vaults and shipping it to Shanghai was $34 per ounce. Not a marginal opportunity, an overwhelming financial tidal force. And that tidal force has been pulling silver east ever since. This is not a pricing glitch. This is not a technical anomaly. This is the physical market in the world's largest silver-consuming nation, telling you that silver at 88 hostelers in the West is a fiction, that the metal that paper contracts claim to represent is being hoovered out of Western vaults and shipped east at a pace that the paper market has not yet been forced to acknowledge. Now I want to show you why China is willing to pay that premium, because the answer is not what most people think. And once you understand it, the entire picture snaps into focus. This is not a recent development. This has been building for years. And there was a moment when China made a decision that changed everything. 3 years ago, China made a strategic calculation. The United States dollar had been used as a weapon against Russia. Sanctions, asset freezes, swift disconnection. China watched what happened to Russian dollar-denominated reserves when geopolitical relations broke down, and they made a decision. They were going to move out of dollars, and they were going to do it using gold. For 3 consecutive years, central banks globally bought over 1,000 tons of gold annually. China was the largest buyer. The People's Bank of China added gold for 14 consecutive months. Independent analysts at Beijing-based Plenum Research estimated that China's real accumulation in a single recent year may have been 6 times their officially reported figures, moving through sovereign wealth funds and state-owned enterprises that do not show up in IMF data. The result was gold going from under $2,000 per ounce to over $5,000, a 150% increase. The dollar's share of global reserves has been falling. Countries all over the world watched what China was doing and followed. The gold attack worked. Now China is making the same move with silver, and the playbook is identical. Classify it as strategic, restrict the export, hoard the domestic production, buy everything available on the physical market at any premium required, and position yourself to control the supply that the rest of the world needs. Right now, China has already put new silver export controls into effect. Quietly. No headlines, no panic. Just a regulatory update that most people never read. But the ones who did understood exactly what it meant. Only 44 state-approved companies can now export silver from China. To qualify, you need annual production capacity of at least 80 tons and a credit line above 30 million. That wiped out hundreds of smaller and mid-sized exporters overnight. China controls between 60 and 70% of the world's refined silver supply. Not silver mining. Refined silver. The metal in bar form that industrial users need to build solar panels, electronics, electric vehicles, and defense systems. In one regulatory move, China locked the door on 2/3 of the world's refined silver supply. And they kept the key. Elon Musk posted on X the day the restrictions were announced. He said this is not good. Silver is needed in many industrial processes. He did not elaborate. He did not need to. Anyone who understood what China had just done understood the implications immediately. But here's the piece that turned this from a market story into something much larger. 1 month after China's export restrictions went into effect, the United States Geological Survey updated its critical minerals list. Silver made the list for the first time in history. Both superpowers classified silver as a strategic national security material within weeks of each other. When I first noticed that timeline, I thought it might be coincidence, Then I kept pulling the thread. And the coincidences stopped looking like coincidences, because here is what happened next. And this is where it gets serious. I want you to think about a room in Washington, D.C. on February 4th, 2026. Secretary of State Marco Rubio is standing at a podium. Vice President J.D. Vance is there. Treasury Secretary Scott Bessent is there. And so are the foreign ministers of 43 countries who had flown to Washington specifically for this meeting. Rubio said something that I need you to hear directly. He said, "We embraced what was new and glamorous and outsourced what seemed old and unfashionable. And then one day we woke up and we realized we had outsourced our economic security and our very future. We were at the mercy of whoever controlled supply chains for these minerals. That is the Secretary of State of the United States, describing the situation his own country is in to 43 foreign ministers at a summit dedicated to one subject, critical minerals, silver included. And the most consequential thing that happened at that summit did not make the front page of any major newspaper. On that same day, the United States and Mexico signed a bilateral critical minerals action plan, a formal agreement giving both governments 60 days to develop coordinated trade policies, price floors, and joint investment frameworks for the minerals that power every AI chip, every electric vehicle, every advanced defense system that either country builds. Now watch what happens next, because this is where the two stories collide. 18 days after that bilateral agreement was signed, a joint U.S.-Mexico military intelligence operation tracked El Mencho to a remote compound outside Tapalpa, Jalisco. 6 helicopters, special forces, armored vehicles, 3 soldiers wounded, a helicopter in emergency landing, 8 cartel operatives dead in the firefight. Nemesio Oseguera Cervantes, El Mencho, founder and leader of the Jalisco New Generation Cartel, shot during the operation, dead on the helicopter being flown to Mexico City. White House Press Secretary Caroline Leavitt confirmed it Sunday night. Deputy Secretary of State Christopher Landau confirmed the death on the record. The Mexican Defense Secretary confirmed U.S. intelligence support was used to locate the target, a $15 million U.S. government bounty. Collected. I'm not telling you the bilateral minerals deal and the El Mencho operation are directly connected. I'm showing you the timeline and letting you draw your own conclusion. What I will tell you is this. The U.S. government modeled the scenario where Mexico stops exporting silver to the United States 3 months ago. They concluded it would cause a national security-level GDP decline. They classified it accordingly. Then they signed a strategic minerals partnership with Mexico. Then a joint operation destabilized the cartel controlling key portions of Mexico's mining corridor. Those things happened in that order. Now let me show you what Mexico's silver supply actually looks like on the ground, because the paper price is not seeing any of it. Mexico produces 186 million ounces of silver per year, according to the latest Silver Institute data. The single largest producing country on Earth, forecast to deliver much of the growth in global mine supply in 2026. 70% of all silver consumed in the United States is imported. More than half of those imports come from one country, this one, and that supply chain was already breaking badly before El Mencho was ever killed. When I started putting this video together, I expected to find a complicated picture. What I actually found when I went through the ground level reporting is that the disruption was deeper than any of the official data was showing. In January 2026, 10 workers were abducted from Vizsla Silver's gated residential compound in Concordia, Sinaloa. Engineers, geologists, administrative staff, taken from inside a secured perimeter, 5 of those 10 have been confirmed dead. Their bodies were found in a mass grave near the village of El Verde, 15 kilometers from the compound. 5 remain missing. Vizsla suspended operations at the Panuco project, the world's largest undeveloped high-grade silver resource at over 100 million ounces. Sitting idle, Vizsla's share price fell more than 50%, and here is the detail I had to sit with for a long time. That attack happened when the CJNG was fully intact. Maximum command coherence, full organizational stability. That was the level of violence against a secured mining compound under normal cartel operating conditions. Al Jazeera confirmed this week that there is no obvious successor to El Mencho. His son, El Menchito, is in a U.S. prison. His brother is in a U.S. prison. His daughter is imprisoned. Every branch of the succession line is closed. Security analyst David Saucedo told CNN directly. Commanders will enter a succession war to determine who takes control. He warned the cartel could adopt a posture of total war against the Mexican state. That process does not resolve in days. History says it resolves in months, sometimes years. And every day it continues, Mexico's contribution to global silver supply compounds its disruption. Now here is what the supply chain looks like on the ground right now. And this is the part nobody's pricing in yet. After the Vizsla abduction, transportation insurance for refined silver bars in the affected regions became in many cases unobtainable. Insurers assessed the risk. They stopped writing the coverage, so miners changed how they move metal. Instead of smelting ore into recognizable silver bars, operations in the affected regions started loading raw ore into trucks, truckloads of material indistinguishable from ordinary dirt. The silver is still in it, but it cannot be identified until it reaches a smelter somewhere else. But watch what happens to that metal once it leaves the mine. Major industrial end users with the resources to arrange private logistics have been structuring off-market deals to pull silver directly from Mexican producers. Air freight, private transport chains bypassing the commercial market entirely. Samsung confirmed exactly this kind of move. Samsung C&T finalized a deal with Silverstorm Mining, giving Samsung exclusive rights to purchase 100% of the La Parilla silver mine's output for 2 years, a $7 million prepayment facility. The entire mine, locked up. Think about what that decision means inside Samsung's boardroom. An executive stood up and said, "We cannot trust the market to supply our silver anymore. We need to go directly to the source before it is gone." And that silver is not going to COMEX. It is moving directly from mine to manufacture through arrangements built specifically to bypass the public market. Every ounce moving through private channels is one less ounce available to replenish what COMEX needs, and COMEX needs replenishment badly right now. This is where everything collides. COMEX registered inventory is the physical silver sitting in exchange-approved vaults backing every futures contract traded on the exchange. Think of it as the foundation underneath a skyscraper of paper promises. That foundation is collapsing in real time. 4 months ago, registered inventory was 167 million ounces. Right now, it sits around 82 to 89 million ounces. A 47% collapse in 4 months, a drain running at 785,000 ounces per day every single day. One direction, out. On February 11th alone, a single-day negative adjustment of 3.26 million ounces pulled registered silver below 100 million ounces for the first time in years. And sitting against that 82 to 89 million ounces of physical silver is the March futures contract, representing hundreds of millions of ounces of paper exposure. 5 people claiming the same ounce, all 5 wanting delivery at the same time. February 27th is first notice day for March. That is the countdown. The delivery math at current inventory levels does not work. Now I need to put all of this into a framework that explains why the paper price is still at $88, while everything underneath it is under this kind of stress. China attacked the dollar using gold, accumulated thousands of tons through official and undisclosed channels, reduced treasury holdings from $1.2 trillion to $775 billion over several years. And Bloomberg reported just 2 weeks ago on February 9th that Chinese regulators have now instructed banks to actively reduce their U.S. treasury holdings further. The capital has to go somewhere. And China has already told the world exactly where they are directing it. The same playbook as gold, but this time the target is silver. The Chinese state-run Securities Times cited an unnamed industry insider confirming that the new silver export policy formally elevates silver from an ordinary commodity to a strategic material, placing it on the same regulatory footing as rare earths, the same rare earths playbook, the same strategic classification, the same export restriction architecture, the same domestic accumulation while restricting supply to the rest of the world. China ran this play with rare earths. It worked. China ran it with gold. It worked. Now they are running it with silver. And the Western paper market is pricing the risk at zero. Here's the supply math that explains why that cannot continue. The Silver Institute published their 2026 market forecast last week, the most current data available anywhere. They confirmed that 2026 will be the 6th consecutive year of structural supply deficit, 6 straight years where the world consumes more silver than it mines. The projected shortfall for 2026 is 67 million ounces. That is according to Metals Focus, the most respected silver research consultancy in the world. But that 67 million ounce deficit was calculated with Mexico producing at forecast levels. It was calculated before the succession war opened in the CJNG, before Vizsla suspended operations, before transportation insurance became unobtainable in the producing regions, before the private off-market deals started pulling supply out of the commercial pool. And it was calculated before the Silver Institute's own data showed that the 5-year cumulative deficit from 2021 through 2025 has already consumed over 800 million ounces of above-ground stockpiles, an entire year of global mine production, gone from inventory, never to be replaced at current mining rates. Now add the China export restrictions. China controls 60 to 70% of global refined silver. Even a partial reduction in Chinese exports instantly creates supply shock on a scale that no other region can compensate for. The Silver Institute said it directly in their forecast. The silver market will continue to rely on the drawdown of above-ground bullion inventories to bridge the gap. Those inventories are the COMEX vaults. Those vaults are draining at 785,000 ounces per day. Here is the historical comparison that makes the stakes concrete. When Russia's invasion of Ukraine removed 10% of global wheat exports, wheat futures spiked 40% in weeks. Not gradually, all at once, after months of the market treating the risk as remote. A 10% supply removal produced a 40% price move. Mexico is not 10% of global silver supply. Mexico is the world's largest silver producer. China controls 60 to 70% of global refined supply and has just restricted exports, both simultaneously. The cumulative 5-year stockpile drawdown is already 800 million ounces. COMEX vaults are at 82 million ounces and falling. Do that math yourself. I want to give you the honest bearish argument, because this video has big numbers and you deserve to hear the full picture. The large cap operators in Mexico, First Majestic, Fresnillo, Pan American Silver, Endeavor Silver, have operated in complex security environments for decades. They have evacuation protocols, federal government relationships, balance sheet resources. One cartel leadership transition does not automatically halt the best resourced operations. Mexico's government has enormous incentives to protect mining infrastructure. Mining contributes materially to GDP, foreign exchange earnings, regional employment. Military deployments to protect critical industry have happened before. And on China's export restrictions, the Silver Institute noted in their February forecast that earlier uncertainty about China's silver export policy briefly raised fears of supply disruptions, though concerns have eased in recent weeks as the practical implementation has been less severe than initial fears suggested. These are real counterpoints. They explain why the worst scenarios may not fully materialize. But here is what the bears cannot explain. The Shanghai premium to COMEX hit 29% on February 2nd. Even at current reduced levels, it remains consistently elevated above historical norms. That is not easing concern. That is a sustained physical price signal. COMEX registered inventory has fallen 47% in 4 months. The drain is ongoing. Transportation insurance for refined silver bars in key Mexican producing regions is currently unobtainable. The insurance market already rendered its verdict. Vizsla's operations are suspended. Their stock is down over 50%. The Silver Institute confirmed 6 consecutive deficit years, with an 800 million ounce cumulative drawdown from above ground stocks. Samsung locked up an entire mine directly rather than trusting the market. Every one of those facts is verifiable right now from the sources I'm about to give you. The bears explain why the ceiling might be lower than the most extreme scenarios suggest. They do not explain why the risk that has already materialized at documented measurable levels is priced at zero. Here is what you watch now to know when that changes. Watch the Shanghai premium. If it holds consistently above 10%, the arbitrage is still draining Western vaults toward China. The drain continues. The inventory pressure builds. Watch COMEX registered inventory daily. At current drainage rates, the math gets increasingly difficult to ignore as February 27th, first notice day, approaches. Watch whether the drain accelerates from here. Watch Mexico. Any operational suspension announcement from a major producer, any force majeure language, any vague press release about enhanced security reviews or logistics adjustments is the signal that the disruption has reached a scale requiring legal disclosure. One announcement reprices every operation in the same geography instantly. Watch whether the Chinese treasury reduction continues. Bloomberg reported on February 9th that regulators are actively pushing banks to reduce their exposure. Watch where that capital flows. The Forex reserve data gets updated monthly through SAFE. None of these signals is at maximum intensity right now. The question is whether that means the risk is being correctly assessed as manageable, or whether the clock is simply still running. Here is what I know for certain. The US government classified silver as a critical national security material. They modeled the Mexico disruption scenario. They signed a strategic minerals partnership with Mexico, all before El Mencho was killed. China classified silver as strategic on the same rare earths playbook that has worked twice before for them. They restricted exports, controlling 2/3 of global refined supply. Their own recyclers were paying above global spot for scrap to keep domestic production lines running. The Silver Institute confirmed 800 million ounces of cumulative stockpile drawdown over 5 years, and a 6th deficit year beginning right now. COMEX vaults have lost 47% of registered inventory in 4 months. The drain continues at 785,000 ounces per day. Samsung is buying an entire mine directly, not through futures, not through the open market. Directly, because they cannot trust the market anymore. 2 superpowers reached for the same metal at the same time. Both of them classified it as a national security resource. And the Western paper market is pricing all of that at $88. The Shanghai market already figured out this is not an $88 metal. The insurance market already figured it out. The equity market already figured it out when it cut Vizsla in half. The Samsung boardroom already figured it out when they bypassed COMEX entirely. The Western paper market is the last one to know. And markets that are the last to know do not adjust slowly when they finally do. They adjust all at once. That is what you're watching right now. The gap between what 2 superpowers know about silver and what the paper price is saying, that gap does not stay open forever. If you want analysis like this before the market forces everyone else to understand it, subscribe. Because most people will not figure this out from data. They will figure it out from price. And by the time price teaches the lesson, it is already too late. Right now, the physical market is telling you one thing while the paper market is telling you another. And that split does not last. It never has. Every time this kind of disconnect shows up, it resolves the same way. Fast, violent, without warning. You're either early to that realization, or you're part of the move when it happens.